Warren Buffett's interpretation of financial reports. Number 47. Treasury stock. We like to see this on the balance sheet. When a company buys back its own shares, it can do two things: cancel them or retain for later reissuing. Carried on the balance sheet as treasury stock under shareholders' equity. Treasury stock has no voting or dividend rights. They are carried on the balance sheet as a negative, reducing the shareholders' equity. A D.C.A. company has cash to buy back its shares. So treasury shares is a good indicator of the presence of a D.C.A. company when held as treasury stock. Effectively, it's decreasing the company's equity while increasing the return on shareholders' equity. This is a good sign of a D.C.A. company. To see if there is any financial engineering, convert the negative value of treasury stock to positive. Add to the shareholders' equity. Then divide the net earnings by the new shareholders' equity. This will give you the return on equity, minus any financial engineering. The presence of treasury stock on the balance sheet and buying back of shares is a good indicator of a D.C.A. working in its favor. Another business tip from LearnAccountingFast. Next, return on shareholders' equity. Part 1.